We're going to go through some tricky parts of the cash flow projections. First being depreciation. Is it non-cash? I thought it was non-cash. Or is it? Second is capital gain or loss on the sale of a depreciable asset. You buy a truck, you use it for a while, you sell it. Well, does that event have cash flow implications? And if so, how do we determine what that cash flow is? Is it profit? Is there tax, etc.? And third is working capital. We know that it is required to have working capital as we grow a business. We have to have inventory. We have to have receivables, things of that sort. We also have bills to pay our vendors. So how do we consider that? And how would we have that go from year to year? And it's not, none of these you'll find are particularly tricky. You just have to learn how to do it, and we'll go from there. So we'll be doing those three right now. So first we'll start with depreciation. And this is probably, again, a refresher. You've seen this, I'm sure, in Mod A in your financial accounting. And we're going to look at three different methods. The three methods are straight line, an accelerated method called the double declining balance method, the third being an accelerated approach used by tax authorities or permitted by tax authorities called the MACRS, the Modified Accelerated Cost Recovery System. So straight line is the simplest, and I'm sure you recall this one, if any of the three. It's where you take the annual depreciation equaling the cost of the asset minus the estimated salvage value at the end of its life divided by its useful life. Next, on double declining balance, and we'll do an example, it's probably easier to try to read this and remember it. We take a rate, which is what is the straight line rate, and that is equal to 1 divided by the useful life, and then double it. That percentage represents the rate that you're going to multiply times the beginning book balance of that asset. And we do that every time we go through it until the last year, in which case we must do the depreciation to sync up and meet our salvage value target. Again, it's easier just to see it, which we'll do in an example after this slide. MACRS is a system that's allowed by the Internal Revenue Service, and it is an accelerated method. One thing to realize about MACRS is that there's no salvage value. We get to depreciate the entire amount over a prescribed schedule. And this example here is what happens if it's a 4-year MACRS, and it goes 33, 44, 14, 7. You might wonder, why is 33 lower for year 1 than year 2? When we all know that the asset value often drops the fastest in the first year. The reason is MACRS allows you to use that percentage regardless of when we place the asset in service. So that's a pretty big computational convenience to not have to prorate for how many months of depreciation took place in that particular tax year. The asset that we'll look at will have book values, and we're going to look at how those book values change over time, which is based upon the depreciation schedule and what is the net book value at the end of each period. Cash flow impact is tricky because annual depreciation expense is a deduction for tax purposes. So depreciation expense reduces our taxes. However, when we go back to determining our cash flow, we have to add back depreciation to the net income because the depreciation expense itself was non-cash. So it's this bit of a dance. We subtract depreciation expense, which will lower our taxes, and then we add it back because we didn't really mean to lower our cash flow. And again, we'll look at an example right now. We're going to use an example for this whole set, and just starting with the depreciation portion, we have an asset that cost us $200,000 plus $10,000 for shipping and $30,000 installation. So the total is $240,000. So let's pause there for a moment. This is the depreciable base of that asset because that's the total cost that it took to place the asset into service. So it's true that it only cost us $200,000, but we would not have had that asset working if we didn't spend the $10,000 to ship it and we didn't pay $30,000 to get it installed properly. So the depreciable asset base is $240,000. Economic life is 4 years. We'll use that for our depreciation. Salvage value 25 if applicable. And now we're going to jump into 3 methods: straight line, double declining balance, and MACRS. So I'm going to go into Excel at this point. And I just duplicated the information, and we'll just start in with the calculations. The rate equals the 1 divided by 4 in this case, right? And so that would be plus 1 over 4, would be 25%. So 25% of what? Well, the depreciable base equals the original cost minus the salvage value. So in this case, that equals 240 minus 25,000. That's 215,000. So the annual depreciation equals the base times the rate equals the 215 times the rate. So every year, that's per year. And one thing we could do just to test it out to ourselves, to satisfy ourselves that this is correct, is to say what happens in the 4 years. In 4 years, the depreciation, the total depreciation equals 4 times that amount, and that equals 215. And you subtract that from the original cost of 240, and that equals 25,000, which is a book value. So at the end of 4 years, we would have taken 215,000 of depreciation. When we subtract that from the original cost of 240, we end up at the salvage value. Salvage value equals book value. All right, so that's the easy one. Let's do the next one a little trickier. So this one we should build a little table, beginning balance, and then we have depreciation, and then we have accumulated depreciation, and then we'll have the ending balance. So let's start when the year begins, year 1 begins, and the original cost, the balance is 240,000. And so the depreciation equals, and we'll just do a calculation here, the DDB rate equals the straight line rate, so 1 divided by 4 times 2. So double decline balance means we're doubling the straight line rate. So that's 50%. Depreciation is 50%, which is 120,000. Accumulated, this is the first year, so it by definition is the accumulated depreciation. And the ending balance is equal to the beginning balance minus this year's depreciation. Okay, so then the tricky part is that remember that the beginning balance is equal to the ending balance from the prior year. This is a step, this is one of the 2 tricky parts that cause people to get this incorrect. Here again, we're going to have depreciation equals that times 50%, right? So accumulated now equals the accumulated before plus this year's new depreciation is 180. And the ending balance now is 120 minus the new depreciation. And the third year, same thing, is 60,000, and it's times 0.5 of the 60. That's this year's depreciation. And the new balance is last year's plus this year's. And the new ending balance is 60. 60 plus 30. Beginning balance is ending balance from the prior year. And here's where it gets tricky. And I'd say many people get this wrong. Not most, I hope, but many. We need the ending balance to be equal to the salvage value. So this must equal $25,000. So we're gonna plug it. It's not very graceful. We're gonna plug it. So if we start the year with 30 and we need to end the year with 25, how much is depreciation? Well, it equals 25,000 minus 30. So the answer is 5,000. We need to subtract another 5,000 from the 30 and we'll be good to go. So the accumulate depreciation is that and that. So we've now taken 215 and we're at 25,000. So let me point out the tricky parts. The first tricky part definitely is this. We will plug the ending balance. The other tricky part is remember that these numbers are based on the beginning balances. I mean the ending balances of the prior year. And the other tricky part is this. This is the plug number that gets us to the 25. All right? So that's double declining balance. Next, let's use makers, which is the tax allowed method. The important difference between this accelerated method and double declining balance is that we just use the original cost and we multiply it times the makers percent, and that's it. No other kind of messing around with partial years, no messing around with salvage values. That's all there is to it. So we'll take the original cost, 240, times the percentage allowed. And that's the amount for year one, and we copy that for the other 3 years. And when we sum that total, it will equal, of course, our total amount of money. There is no salvage value makers, and we take this schedule of depreciation. So this is the annual depreciation. And the accumulated, just to be parallel with the other. First year, it's just that, it's first year. Second year, it's the last year's plus the new one. We copy that. When we get to a ending balance, the first year is 240 minus the depreciation expense. The following year, it's the ending balance minus, and we carry that through the entire period. And notice this goes to 0 by definition. We have no salvage value in makers. All right. So now we've completed depreciation. Straight line is a simple one. The rate's simply 1 divided by the number of years, a quarter, and it's the same every year. That rate every year. Double declining balance, we take the rate of double the straight line rate. If it's 4 years, 1 divided by 4 is 25%. Double it is 50%. So the depreciation expense every year is, or the first 3 years anyway, is 50% of the beginning balance. And the fourth year is a plug. This 5,000 is a plug so that we go from this number to the target number, which is the salvage value. All right. And makers is one that's tax law based, and we are given these amounts that we can use by the government. We use those rates and just allocate that across the years, and that's our expense. So it's actually computationally very easy. Even though the numbers jump around a bit, the actual math is very straightforward. All right, so that's depreciation. And we'll show how this goes into the cash flow statement in a moment.